By 2021, Zillow had become one of the most influential housing platforms in the United States. While millions of people use the company's website and mobile apps to search homes, track prices, estimate property values, and monitor real estate markets across the country. The company originally built its reputation around digital home listings and its widely used Zestimate system, an algorithm designed to estimate residential property values using massive amounts of housing market data. Over time, Zillow increasingly positioned itself not simply as a real estate website, but as a technology-driven housing company capable of understanding and predicting real estate markets at enormous scale. As the pandemic-era housing boom accelerated, Zillow's market value surged into the tens of billions of dollars, while investors increasingly believed the company could fundamentally reshape how homes were bought and sold in the United States. That confidence eventually pushed the company toward a far more aggressive strategy called Zillow Offers. Instead of only listing homes online, Zillow would now directly purchase houses from homeowners using algorithmic pricing models, renovate those properties, and then resell them for profit. The strategy became part of a growing industry trend known as iBuying, short for instant buying, where technology companies attempted to simplify and industrialize home transactions using speed, automation, and large-scale housing data. For homeowners, the model looked extremely attractive because Zillow promised fast offers, simplified sales processes, and the ability to avoid many of the delays and uncertainty traditionally associated with selling homes. For investors, the opportunity appeared even larger. If Zillow could accurately predict housing prices while operating at massive scale, the company could potentially transform residential real estate into a highly efficient technology-driven inventory business. At first, the timing appeared perfect because low interest rates, pandemic migration patterns, housing shortages, and rapidly rising prices were pushing demand higher across many U.S. markets simultaneously. Zillow aggressively expanded home purchases across multiple cities, while thousands of properties started entering the company's acquisition, renovation, and resale pipeline. Externally, the strategy looked a powerful evolution of Zillow's original business because the company was no longer simply analyzing the housing market. It was now actively participating inside it as a large-scale buyer, seller, and operator of physical housing inventory, backed by enormous amounts of data and predictive forecasting systems. The deeper Zillow moved into large-scale iBuying, the more the company was about to discover that scaling physical housing operations across thousands of real homes was far more complicated than scaling software platforms built around algorithms and data. Zillow's iBuying strategy depended on a very specific operational assumption that the company believed it could scale more efficiently than traditional home flippers, operating through slower local real estate systems. Instead of negotiating individual purchases manually, Zillow used pricing algorithms, housing market data, transaction history, neighborhood trends, and predictive forecasting models to rapidly generate offers on homes across multiple cities. Once Zillow purchased a property, the company would coordinate inspections, renovations, repairs, holding costs, resale preparation, and relisting operations before attempting to sell the home back into the market at a profit. The model depended heavily on speed because profitability often required Zillow to quickly move homes through acquisition, renovation, and resale pipelines before local market conditions changed significantly. If the system operated efficiently at scale, Zillow believed it could potentially transform residential real estate into a highly automated inventory business powered by data-driven forecasting and operational efficiency. At first, the strategy appeared extremely promising because U.S. housing prices continued rising rapidly throughout 2020 and early 2021, while demand remained historically strong in many markets. As prices increased, homes often sold quickly. Inventory shortages supported rising valuations, and Zillow's aggressive acquisitions initially appeared to validate the company's algorithmic pricing confidence. The company rapidly expanded home purchases across cities including Phoenix, Atlanta, Dallas, Houston, Tampa, and several other fast-moving housing markets experiencing intense pandemic-era demand. Externally, the model increasingly looked like a major technological breakthrough because Zillow was no longer simply analyzing housing trends. It was attempting to industrialize the buying and selling of physical homes at enormous operational scale using algorithms, data systems, and centralized forecasting models. However, underneath the expansion sat a dangerous operational reality because every house still required local inspections, contractors, labor coordination, renovation timelines, pricing accuracy, carrying costs, and resale execution inside highly fragmented local housing markets. The larger Zillow's inventory became, the more the company was discovering that scaling physical housing operations across thousands of unique properties simultaneously was far more unpredictable and operationally complex than scaling digital platforms built primarily around software and data systems. During 2020 and early 2021, Zillow's iBuying system entered its most aggressive expansion phase as the U.S. housing market experienced one of the fastest price accelerations in years. Historically low interest rates, pandemic-era migration trends, remote work shifts, and extremely strong housing demand pushed home prices rapidly higher across many major metropolitan regions. In many cities, houses were selling within days, while inventory shortages created intense competition among buyers trying to secure properties before prices climbed even further. Inside Zillow, those market conditions increasingly reinforced confidence that the company's algorithmic pricing systems and large-scale acquisition strategy were working successfully. As home prices continued rising, Zillow aggressively accelerated purchases across multiple markets simultaneously, while inventory volumes expanded rapidly throughout the company's operational pipeline. Thousands of homes were now moving through acquisition, inspection, renovation, repair, financing, and resale systems at the same time across geographically fragmented housing markets. At first, the rising market helped hide many operational weaknesses because even delayed homes could often still be resold profitably while prices continued climbing. That created a dangerous form of false confidence inside the system because Zillow's rapid growth increasingly appeared to validate the assumption that large-scale algorithmic home flipping could remain profitable at national scale. However, underneath the expansion, operational pressure was beginning to accumulate much faster than the company's centralized systems could comfortably absorb. Contractor shortages started slowing renovations. Inspection timelines became inconsistent across cities. Repair costs increased, and local market conditions began shifting faster than some pricing models could accurately adjust in real time. The larger Zillow's inventory became, the harder it became to keep acquisitions, renovations, resale pricing, and market timing synchronized across thousands of individual properties operating inside highly localized housing conditions. By mid-2021, Zillow's expansion strategy was beginning to collide directly with operational realities of managing thousands of physical homes across rapidly changing local housing markets. The company's algorithms could estimate pricing trends at large scale, but every individual property still depended on inspections, contractors, renovations, material availability, resale timing, and local buyer demand conditions that varied dramatically from city to city. As inventory volumes expanded, operational delays started spreading through Zillow's system much faster than the company initially expected. Homes purchased weeks earlier often entered renovation pipelines later than planned, while labor shortages and rising material costs slowed repairs across multiple markets simultaneously. That delay became increasingly dangerous because Zillow's profitability depended heavily on accurately predicting future resale values during extremely fast-moving housing conditions. If renovation timelines slowed while local market momentum changed, homes purchased aggressively at peak pricing could suddenly lose expected profit margins before resale even occurred. At the same time, Zillow continued buying homes at enormous scale because the housing market was still rising across many regions, and the company remained heavily committed to expansion. Thousands of additional houses kept entering inventory, while operational systems underneath the business were already beginning to lose synchronization. Some homes required larger repairs than expected. Certain local markets cooled faster than forecasting models predicted, and pricing assumptions that initially looked profitable started becoming increasingly fragile once operational delays expanded across inventory pipelines. The deeper Zillow moved into large-scale iBuying, the more the company was discovering that housing markets were not uniform national systems that could be managed purely through centralized algorithms. Every neighborhood contained unique local pricing behavior, contractor availability, buyer demand patterns, renovation conditions, and timing risks that became increasingly difficult to coordinate once inventory scaled into the thousands. Externally, Zillow still appeared to be operating inside a booming housing environment, but underneath the surface, the company's operational complexity, inventory exposure, and pricing risk were now compounding simultaneously across a system becoming harder to control at scale. By the second half of 2021, Zillow's iBuying system was beginning to experience severe inventory pressure as operational delays, pricing inaccuracies, and slowing resale conditions started colliding simultaneously across the business. The company had now accumulated thousands of homes across multiple housing markets, while renovation pipelines, contractor coordination, inspections, and resale operations were increasingly struggling to keep pace with acquisition volumes. By late 2021, Zillow reportedly held roughly 7,000 homes in inventory across the United States, while billions of dollars were tied directly into housing exposure moving through the company's operational pipeline. As inventory expanded, holding costs continued rising across Zillow's balance sheet because every unsold home carried financing expenses, maintenance costs, taxes, utilities, insurance obligations, and operational overhead while waiting for resale. At the same time, some housing markets that had previously experienced explosive price growth started becoming less predictable as inventory conditions and buyer behavior shifted during late 2021. That change became extremely dangerous for Zillow because the entire iBuying model depended heavily on accurately forecasting future resale values while moving homes quickly through the operational pipeline. If homes stayed inside inventory longer than expected, profit margins could disappear rapidly once financing costs, repair expenses, and local pricing adjustments started accumulating simultaneously. Some properties purchased aggressively during peak market conditions were now becoming increasingly difficult to resell at the margins Zillow originally expected. Operational delays made the situation worse because homes waiting for renovations or repairs often reached the market later than pricing models initially projected. The larger Zillow's inventory became, the harder it became for centralized systems to respond quickly to rapidly changing local market conditions across thousands of unique properties. What initially looked like a highly scalable, technology-driven housing system was now increasingly behaving like a massive operational inventory network exposed to real-world market friction at national scale. Internally, Zillow's synchronization problems were becoming more severe as acquisitions, renovations, Pricing systems, contractor availability, and resale timing all started drifting further out of alignment simultaneously. Externally, the housing market still appeared relatively strong in many regions, which initially masked how much operational stress was building underneath Zillow's rapidly expanding inventory exposure. But underneath the surface, the company was now carrying enormous financial risk across thousands of physical homes, while the operational systems required to manage that inventory were becoming increasingly unstable under scale pressure. The deeper Zillow moved into large-scale iBuying, the more the company was discovering that even small forecasting errors became extremely dangerous once they multiplied across thousands of homes, moving through an already overloaded operational system simultaneously. By November 2021, Zillow's iBuying strategy had reached a breaking point as the company's operational systems, inventory exposure, and pricing assumptions were now deteriorating simultaneously across the business. The synchronization problems spreading underneath Zillow Offers had become too large to stabilize efficiently at national scale. Homes were moving through renovation pipelines slower than expected. Resale timing was becoming increasingly inconsistent, and forecasting models were struggling to react accurately to rapidly changing local housing conditions across thousands of properties simultaneously. What initially appeared to be a highly scalable, technology-driven housing operation was now behaving like a massive inventory network overloaded by operational friction, local market unpredictability, and growing financial exposure. Zillow had spent years building confidence around its ability to understand housing markets through algorithms and data systems. But the deeper the company moved into large-scale iBuying, the more it discovered that physical housing operations contained layers of local complexity that became extremely difficult to standardize nationally. Small pricing inaccuracies multiplied across thousands of homes. Delayed renovations increased carrying costs, and operational slowdowns created growing resale risk across inventory purchased during extremely aggressive market conditions. In November 2021, Zillow officially announced it was shutting down Zillow Offers and exiting the iBuying business entirely. The company stated that its forecasting models and operational systems had become unable to accurately predict future housing prices at the level of precision required for stable profitability. At the time of the shutdown, Zillow still held thousands of homes in inventory, while the company rushed to liquidate properties and reduce exposure across multiple housing markets. The collapse triggered major layoffs across Zillow's workforce, while the company absorbed hundreds of millions of dollars in losses connected to the failed expansion strategy. For investors and analysts, the shutdown became one of the clearest signs that large-scale algorithmic home flipping was far more operationally unstable than many technology companies originally believed during the housing boom. What failed was not simply a housing market prediction model. The deeper failure came from attempting to industrialize one of the most localized, operationally fragmented, and physically complex markets in the economy, using centralized systems that became increasingly unstable once scale, timing pressure, and real-world operational friction collided simultaneously. The collapse of Zillow Offers became one of the clearest warnings that large-scale algorithmic systems could not easily eliminate the physical complexity of real-world housing markets. For years, technology companies had increasingly believed that large data sets, predictive algorithms, centralized forecasting systems, and operational scale could simplify industries traditionally considered fragmented and inefficient. Zillow attempted to apply that logic directly to residential real estate by transforming homes into fast-moving inventory assets managed through pricing models, automation systems, and national operational pipelines. At first, the strategy appeared highly convincing because rising housing prices and strong pandemic-era demand temporarily masked many of the deeper operational weaknesses underneath the system. But housing markets were never truly uniform national systems. Every city contained different contractor availability, buyer behavior, pricing sensitivity, renovation conditions, financing timelines, labor shortages, seasonal trends, and local market risks that constantly shifted in unpredictable ways. As Zillow expanded nationally, those local differences became increasingly difficult for centralized systems to coordinate accurately at scale. The company's algorithms could estimate broad market patterns, but they could not fully eliminate the operational friction, timing delays, and local unpredictability attached to thousands of physical homes moving through real-world renovation and resale pipelines simultaneously. What initially looked like a highly scalable technology platform gradually transformed into a massive operational inventory network carrying billions of dollars in housing exposure, vulnerable to timing errors, pricing shifts, and synchronization failures. After absorbing hundreds of millions of dollars in losses and shutting down Zillow Offers entirely, the company's failed expansion became one of the clearest warnings about the operational limits of large-scale algorithmic home flipping. The collapse permanently changed how many investors and technology companies viewed large-scale iBuying models afterward. It also exposed a much larger structural lesson about the limits of applying software-style scaling assumptions to industries built around physical assets, local variation, and operational execution complexity. Zillow did not fail because housing demand disappeared completely. The company failed because the speed of expansion, operational coordination requirements, inventory exposure, and forecasting precision required for stable profitability became too difficult to maintain simultaneously at national scale. The story was never simply about a housing company losing money during a difficult market cycle. It was about a technology-driven system discovering that scaling physical real estate operations across fragmented local housing markets was far more operationally unstable than the original algorithms had assumed.